Welcome to our channel. Today we're diving into the world of derivatives. Now, I know just hearing the word derivatives might make you want to click away. It sounds complicated, maybe even a little scary. But trust me, understanding derivatives is crucial if you're serious about investing and building long-term wealth. By the end of this video, you'll have a solid understanding of what derivatives are, how they work, and the potential benefits and risks they offer. We'll break down complex jargon into simple terms, using real-life examples that you can actually relate to. So, whether you're a complete beginner or just need a quick refresher, grab your notepad and let's demystify derivatives together. So, what exactly a derivative? In simple terms, a derivative is like a side bet. Imagine you and your friend are watching a cricket match. You're convinced India is going to win, so you make a bet with your friend. But instead of betting on the actual outcome of the game, you bet on how many runs Virat Kohli will score. That's essentially what a derivative is, a contract whose value is derived from an underlying asset, like Virat Kohli's performance in this case. In the financial world, that underlying asset could be anything: stocks, bonds, commodities like gold or oil, even the price of a cup of coffee. The point is, you're not directly buying or selling the actual asset. You're making an agreement on how its price will move. Now you might be thinking, why not just buy the asset directly? Well, derivatives offer certain advantages like leverage and hedging that we'll get into later. But for now, just remember, a derivative is a contract that gets its value from something else. Now, let's talk about why people use derivatives in the first place. One big reason is to manage risk, or what's known as hedging. Imagine you're a farmer growing wheat, and you're worried about the price of wheat dropping before you can sell your harvest. You could use a derivative called a futures contract to lock in a selling price for your wheat today, even though you won't harvest it for months. That way, you're protected from any sudden price drops. Another reason is speculation. Some traders use derivatives to make bets on the direction of the market. For example, if you think the price of gold is going to go up, you could buy a derivative that increases in value as the price of gold rises. Of course, if you're wrong and the price of gold goes down, you'll lose money. Finally, derivatives can also be used to gain easier access to certain markets or assets. For example, some assets are difficult or expensive to trade directly, but derivatives can offer a more accessible way to participate in those markets. Okay, so we know what derivatives are and why people use them. Now let's explore some of the most common types. There are four main types of derivatives: futures, options, swaps, and forwards. Futures contracts, like our wheat farmer example, are agreements to buy or sell an asset at a specific price on a future date. Think of it like pre-ordering something for a set price, even if the price changes later. Options, on the other hand, give you the right, but not the obligation, to buy or sell an asset at a certain price before a specific date. It's like having a rain check. You can use it if it benefits you, but you don't have to. Swaps are agreements between two parties to exchange cash flows or interest rates. This can be useful for managing interest rate risk or accessing different currencies. Lastly, forwards are similar to futures contracts but are customized and traded privately between two parties. Each type of derivative has its own nuances and complexities, but understanding these basic categories will give you a good foundation. Let's break down options with a relatable example. Imagine you're interested in a company called Tech Solutions, and their stock is currently trading at 100 rupees. You believe the stock price will go up in the next month. Instead of buying the stock directly, you buy a call option with a strike price of 100 rupees, expiring in 1 month. This option gives you the right to buy 100 shares of Tech Solutions at 100 rupees anytime within the next month, regardless of the market price. Now let's say your prediction is correct, and Tech Solutions stock price jumps to 120 rupees. You can exercise your option, buying those 100 shares at the agreed upon price of 100 rupees, and immediately selling them in the market for 120 rupees per share. You've made a profit of 20 rupees per share, minus the initial cost of buying the option. However, if the stock price stays below 100 rupees, you wouldn't exercise the option because you could buy the shares for cheaper on the open market. Your loss would be limited to the price you paid for the option, similar to an insurance premium. Now, before you rush off to start trading derivatives, it's crucial to understand the risks involved. Derivatives can be complex instruments, and they're not suitable for everyone. One significant risk is leverage. Derivatives often allow you to control a large position with a relatively small amount of capital. While this can amplify your gains, it can also magnify your losses. Another risk is their complexity. Derivatives can be challenging to understand, especially for beginners. It's essential to do your research, understand the terms and conditions, and potentially consult with a financial advisor before diving in. Finally, it's important to remember that derivatives are often driven by speculation. This means that prices can fluctuate rapidly and unexpectedly, leading to significant gains or losses in a short period. So there you have it, a beginner's guide to derivatives. We've covered a lot of ground, from what derivatives are and why people use them to the different types and risks involved. Remember, derivatives can be powerful tools for hedging, speculation, and accessing markets. They offer potential benefits, but also come with inherent risks that shouldn't be overlooked. If you're considering trading derivatives, make sure you fully understand the complexities and risks involved. Do your due diligence, start small, and never invest more than you can afford to lose. Thanks for watching. I hope this video helped demystify the world of derivatives and equip you with the knowledge to make informed financial decisions. If you found this video helpful, don't forget to show your support by giving it a thumbs up and subscribing to the channel for more valuable financial insights. And as always, remember to do your own research, invest wisely, and I'll see you in the next video.